Again, Joe, thank you. Thank you for inviting me.
You are very welcome. I want to start, and we'll talk about your transparency ETF in just a minute, but you're so associated with some of the greatest names in technology and some of the biggest, I guess, percentage gainers over the past 3, 4, 5 years. It's almost synonymous with ARK Invest and Cathie Wood at this point. I guess my question at this point would be, with interest rates perhaps finally moving in the opposite direction, does the whole thesis of seeing growth potential that goes out a number of years, as interest rates move up, does it threaten that thesis? And do you expect less robust returns? Is that to be expected in a lot of your funds?
Well, I think the market believes that because our performance this year has been challenged by exactly that, fears of inflation and interest rates picking up. It's been very interesting to us that once Chairman Powell made the statement that perhaps inflation is not transitory, that long-term interest rates actually came down. The bond market is telling us something here, and the yield curve flattened. The bond market is telling us either that we're going into a recession next year because inventories are piling up or will pile up, or that inflation is going to surprise on the low side of expectations. And we would bet more on the latter, although we do believe there's an inventory issue brewing out there.
Well, Cathie, would you tell your investors that, would you emphasize maybe that past performance isn't necessarily guaranteed in the future, the type of outsized returns that some of your major holdings have delivered in the past? Is that fair to say?
Well, we always say that, but I will tell you, since February through today, we have seen such a correction primarily in innovation stocks as the market has scaled to all-time highs that based on our estimates, and of course we could be wrong, our 5-year compound annual rate of return expectation has gone from 15% at the peak in March to nearly 40% today. So from a doubling over 5 years to a quadrupling over 5 years. Now, we could be wrong, but I think our research on innovation is the best in the business. And I also believe that most investors, and I know the most seasoned investors out there, some of them are saying that our stocks have been in bubble-like territory. We couldn't disagree more because we are seeing 5 major innovation platforms involving 14 technologies, all moving into exponential growth trajectories simultaneously, and they're converging. If we're right that autonomous taxi networks are going to evolve during the next 5 to 10 years, then that involves the convergence of 3 major platforms: robotics, energy storage, and artificial intelligence. And all of them are scaling dramatically. What I like about this period is many people are saying those stocks were in a bubble and they deserve to correct. That tells me we are nowhere near a bubble. In fact, quite the opposite has happened. All of the seeds for what is going on right now were planted in the 20 years that ended in the bubble. They've germinated for the last 20, 30, almost 40 years. And now they're about to flourish and people are running away. They ran toward them way too soon during the tech and telecom bubble. And here we are, ready for prime time. And we've got all this fear, uncertainty, and doubt. As a portfolio manager, I actually love that backdrop.
I find the discussion fascinating, and I've been approaching it from 2 sides, Cathie, and that is, okay, rates probably are headed up. Some of these innovations are going to take years to come to fruition, so you won't see near-term earnings, EBITDA. You won't see any of that, maybe. But to get in on these things, at this point, if innovation is going to continue to the time that it takes to shrink, and I actually, I'm a Kurzweil fan and singularity and everything else. I mean, the time dilation for quantum leaps in technology is getting smaller by the year. So you may have to pay up because it's going to happen much faster than people think. And we've seen that in a lot of the stocks that you've been in already. So maybe I hate to say it might be different this time because it never is, but I don't know whether you need to worry about multiple contraction when you're at the forefront of some of these just earth-shattering innovations. Does that make sense?
Yeah, and it makes sense. And there's one other assumption we make when we're talking about valuations. We assume massive multiple compression down to FANG-like multiples in 5 years in our 5-year projection. So we're already assuming multiple contraction just to be conservative. Now, do we think that the stocks in our portfolio and the companies underlying them are going to be as mature as the FANGs in 5 years? No, we're just being conservative, very conservative. Most, I guess, because of where we are today and the PE ratios, many people think we're in nosebleed territory. What they don't understand is we assume massive multiple compression. And I won't say we assume it either because interest rates are going up. In fact, the convergence between and among the 5 major technologies, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, that convergence is going to be so massively deflationary that we actually think interest rates will remain surprisingly low.
But I'm back to now, just flipping to the other side, it doesn't seem like it's always going to work to pick the most beloved growth stocks, put them in an ETF, and assume that you're going to have great returns and become iconic, which you have done, Cathie. Let me ask you about crypto, which there's a piece out. I think maybe CNBC even talked to money managers, and that is ripe in 75% of those polled. That's ripe for a major correction or a major letting out of a lot of air in that sector. Does that sound like consensus, something to go the other way on to you, or not?
Well, yes, I believe it is. I think institutions are moving in. And right now, crypto of any sort, they're starting with Bitcoin and Ether. Crypto of any sort is a de minimis amount or percentage of institutional portfolios. The reason institutions are moving in is, to some extent, this is a new asset class with correlations very different compared to other asset classes. In fact, Yassin Almandra did a study on this and found that the closest, and we did it with Bitcoin, the closest correlation to other assets was real estate. And so institutional managers have to look at new asset classes that are evolving that have low correlations. That's the key to diversification, and it's the holy grail in terms of asset allocation. So we think that the move actually by institutions into Bitcoin, if we were to choose Bitcoin, and that seems to be their first stop, could add $500,000 to Bitcoin's price if they moved into the tune of roughly 5% over time.
Cathie, could talk about, I guess we'd be remiss if we didn't talk about Tesla or Twitter or some of your other holdings. Can you opine quickly on what do you think about Tesla and where it is right now? Elon Musk's recent comments about the build back better, build back better, build, a lot of B's. But can you comment on that and Twitter? I know you recently...
I tend to agree with Elon Musk. I think more people understand now that the electric age is here. And so Tesla is being rewarded accordingly. It has the highest market share out there, and it has even now 4 barriers to entry that other companies are having difficulty overcoming, especially when it comes to battery technology and artificial intelligence, which will lead to autonomous. And that's now where Tesla is undervalued. You have to assume that the autonomous strategy is going to work. We assume in our $3,000 forecast that there's a 50% chance that its autonomous strategy is going to play out. And our confidence is beginning to increase now that the pilot test is taking place, and you've got devoted Tesla owners really identifying the corner cases that are causing problems for full self-driving. So we're pretty excited about that. Even its electric strategy should take the stock much higher than it is right now. But we are gratified to see that others are beginning to understand this story, and that Tesla is acting a little more FANG-like than it ever has.
How about Twitter? That you got to buy that and just, I guess, not watch it every day. Probably there's a lot of headwind. Yeah.
Well, we love, so the new CEO, we think, had been working with Jack closely on some of the new monetization strategies. We think tipping will be one of those. But there is a sleeper in Twitter that we think most people don't understand. We've moved into an age of NFTs, non-fungible tokens, and they will need a verification platform. NFTs are all about scarcity. And verification is testimony to scarcity. So we think Twitter might play a bigger role in that realm. And then, well, the main reason we own it, this we use it prolifically, as you do as well, Joe. And what we're seeing is that this platform, which used to be dominated by tweens, teens, and celebrities in 2012, when we first evolved our research ecosystem, has now evolved to knowledge workers. And we find it essential at ARC to engage with the communities we are researching and actually to become a part of those communities. This is a very powerful social network. And if you're talking about knowledge workers, you're talking about one of the premier demographic profiles out there. So we think from an advertising point of view, you've seen advertising turnaround on Twitter. We think that's going to continue. And we think more and more users will understand how essential this tool is to knowledge workers.
We all want to be transparent, I guess. I don't know. Sometimes I don't feel like being that transparent. But is there definitely a correlation between transparency and stock performance? And I guess that's the rationale behind this new ETF. Explain that to us.
Yes. So Paul Pagnato, who's CEO of Transparency Invest, after the 08-09 crisis, began to study this phenomenon. And of course, 08-09 was all the back of transparency. And so he devised an index, and you can find the index on our website, arc-invest.com, which evaluates which are the 100 most transparent companies in the world. So the ETF is CTRU, C-True, has a nice ring there. And, transparency for ARC, has been golden. We're able to have dialogues with our clients and prospective clients and anyone about innovation. And we have had more coming back to us in terms of information at times than we have put out there. Because as you know, we give away our research. We are radically transparent in terms of giving away our research, disclosing our holdings at the end of every day, as all ETFs have to do, but also disclosing our trades at the end of every day. And it has accrued to our benefit. In many ways, ARC Invest has gone viral as a brand because we're willing to share and engage with our clients, prospective clients, but really anyone in terms of educating them about innovation. The return from transparency has been huge for us.
Well, want to have you back soon, Cathie. Thank you so much. And in the interest of transparency, I have to go to the bathroom so bad. I got to go. So thank you. In the interest of transparency, but I'm out of here. Thanks, Becky.
You said you were opposed to transparency. I almost fell off of my chair. I know your every waking thought and action. You are transparent, Joe, and he's already gone. He's already gone. Yeah, we know where he is. Still to come on Squawk.